I mean, just looking now also on the capital raising side of it, and obviously we're going to come back to Basel III later, but in terms of appetite for bank equity, is that then affected as well by the general uncertainty about bank financing conditions? Are we still in a phase where it's sort of, forced rights issues by those who need to make it, or is there a different sort of element coming into the market, greater stability coming in at this time? I don't mind who kicks off, maybe David, if you want to.
Well, bank equity valuations are the difference between two very large numbers in some respects, and it does get crushed a little bit. What's the demand for bank equity? This week Agricultural Bank of China has raised a colossal sum of bank equity. Last year the market came forward with quite a decent amount. This year, recently, Bank of Ireland have raised bank equity. So the right investment case, that there is a market. I think the issue is really the deterioration in funding conditions. Bankers themselves haven't worked out what the implication of that is yet.
I mean, I think, I don't know if you'd agree, but I can rarely recollect a time when investors' behaviour seems quite so barbelled as it is now. So, no surprise in times of uncertainty and volatility, there's great appetite for treasuries, bunds, fan brief, I'd like to say UK gilts, but that's maybe another topic of discussion. And on one extreme, and then on the other extreme, actually, we see tremendous appetite for emerging markets, good appetite for high yield, certainly very good appetite for bank pref shares at a point in time which perhaps a year ago we would have found slightly surprising. It's everything in between that's the challenge, and particularly FIG senior paper. So, having been on the road with an issuer this week, I mean, it is striking the one asset class that investors seem universally, I won't say nervous about, but unsympathetic to, and that's bank senior paper. And that's simply because the quantum that needs to be raised is so great that even though individually investors can say, accept it's cheap, accept it's very cheap compared to the corporate paper, but I'm happy to remain underweight because I fear it could get cheaper. And I think that's what's going to drive the landscape of the banking sector in Europe in the years to come.
The other comment I would make, which by the way, might be an overriding comment on all classes of issuance, whether we talk senior debt or equity, like both David commented upon. I mean, the market very clearly, and that also goes back to your initial comment when we started that panel. Overall, the market has been open and closed in windows. And effectively, if you know how much you'll have to raise, and you're starting with equity, when there is a window, you should probably go and tap it. You were mentioning Bank of Ireland. UniCredit came earlier this year. I mean, they know the amounts they wanted to raise was fairly limited, and investors understood the story. They went, and the deal went fine. There will be more of that. I think there's a general expectation that even though the final number is not known, significant amounts of bank capital will have to be raised. And when I say bank capital, that's equity to other layers, which by the way are still undefined, and I think we'll come back to that later. And from that standpoint, so that overall amount is undefined. So if you are an issuer and you know pretty much how much you'll need, whether that's based on the stress test or your view of what you will actually need, and if there is a window, go for it.
I mean, there has been a market that's been open all year, and that's been the covered bond market. It's produced a huge volume in the FTSE.
Is that true across the scale, or is there's still that bifurcation there after between
Yeah, I mean,
Northern
we
and
see
Southern
similar
Europe?
tiering in the covered bond market like we see in other asset classes, so like in senior debt currently. But it's true, I mean, the market has been quite good in the past 12 months. Obviously, I mean, it's also a good funding tool for the long end, and we all know that among the problems we have mentioned here, I mean, we also see a big mountain of redemptions coming up, and that also will be a challenge of banks. So the longer you get your funding, the better it is, apart from regulatory challenges we have. So yeah, indeed, it's a good funding instrument. Everybody jumps on it. Yeah, we have to acknowledge that also from the investor base, we need obviously the investors to take up the paper. And in some cases, I mean, we come to some capacity frontiers, yeah, when we speak about market segments like the Spanish, for example, yeah, who have now a bit more difficult times. And then also, there's also a bit of trade-off between senior and covered bonds to some extent. If you really like the name that issues the paper, wants to issue the paper, I mean, you could have a preference for the senior because it gives you a higher spread. So, I mean, the underlying performance of the issuer is independent from the covered pool or from the legislation that is behind. The covered bond is playing also a quite important role. And well, then basically you could sometimes have easier access to the covered to the senior unsecured funding. Yeah.
In itself, you know, I think what you're saying also means that there has never been a more important time for you know, doing your capital management well and funding management well. And if you were cautious and if you planned a couple of years back to be able to access, you know, any market, whether it's from a currency standpoint or secured versus unsecured, you know, you're in a good position today. I mean, if you're a quality issuer and if you have, you know, if you have in theory, because everything is ready internally for you to access the various pockets, then that's where you want to be, because you can issue in the covered market, you can issue in the unsecured market, you can issue in dollars when it's better to issue in dollars, euros, and so on. And some banks, I think, have done a better job in being ready to access, you know, those various pockets in a flexible way.
I actually think I fully agree with what you're saying, and I think there are two parts of that. One is the documentation angle, and making sure that you have the legal capability to access the various pockets of liquidity where they may find themselves at a given point in time. I also think it has to do with credit positioning, and I mean, you mentioned that you were on the road with an issuer earlier this week. I'm not surprised to hear that, because I think that, you know, those that prepared well for the hard times that we're currently living in were the ones that consistently and over time have spent a lot of time and effort and resources on making sure that, you know, the credit investors, not just the equity investors, but also the credit investors, were familiar with the name, with developments around the credit, with the strategy of that particular financial institution, and all those things taken together, combined with, you know, the documentation aspect, leads to a certain number of parties being in a better position than others.